Jim, I have a question for you that was asked in the last webinar that we didn't get a chance to ask, that I didn't get a chance to ask you. So Paula said, this is a follow-up from yesterday. So I understand if you can't answer it in this session, in the estate planning session, but it's about Roths. So does the proposed legislation that would prohibit Roth conversions of after-tax IRAs apply only to the original after-tax contributions, i.e. basis, or does it apply to the entire IRA balance, i.e. basis and earnings?
Well, the earnings of an after-tax dollar, either in an IRA or a retirement plan, are just plain old IRA and retirement plan. So it doesn't matter if they change the law, or if they don't change the law, all the growth, the dividends, the capital gains, the appreciation, et cetera, that part is all going to be taxable. So just to let's just keep it simple. You put $5,000 in a non-deductible IRA, it grows to $10,000. That $5,000 growth on the $5,000 that came in as a non-deductible IRA that's plain old IRA, and whether the law passes or doesn't, or the expected rate or the expected effective date becomes irrelevant. But I'm interested in getting the $5,000 of after tax to get to a Roth before year end, because that's when we think the effective date is going to be, even if the law passes after year end. The growth on after-tax dollars inside an IRA or a retirement plan is the same as plain old IRA or retirement plan. You know, there's no special treatment for the growth of that money. But what I'm interested in is getting the after-tax dollars to a Roth, and that way future growth will be in the Roth, it'll be tax-free, or if you do nothing, or if you miss the deadline, then the $5,000 is always going to be after tax, but then the growth on that will be traditional IRA, 401k, which will be fully taxable, where if we do this, then we have future growth being tax-free, because it then becomes part of the Roth.
Awesome. Thank you, Jim. Okay, so I again want to encourage people to add your questions here. We do have some. Thank you, Ching. I will get to your question right after this one, but we usually have even more questions. So more questions, please, please, please. These guys really love to answer questions, and I really like to hear, you know, the answers to a lot of times there are questions I never even thought about, and their answers are very interesting. So please enter your questions. You can either do it in the chat or the Q&A box, either one. But I actually dug up a question from a prior webinar from Steve, which I think is very applicable. And I'll ask Adam to answer this first. And then if Jim and Larry want to chime in, please be my guest. But Adam, what should investors do with low interest rates and or inflation?
Well, okay, I'll start, and then I'll let Larry chime in. So again, I'll start to talk about the planning first and say, let's talk about your required rate of return. Larry says the need and ability and willingness to take on risk. Starting at the high level, we are not fans of reaching for yield. And all of the Nobel Prize winning evidence says, don't go out and buy, for example, high yield bonds or corporate bonds. They're more correlated to stocks. Yes, you're picking up some extra yield, but it's not worth the risk you're taking. So we start with that plan, if you will, the asset allocation in those parameters, whether the plan says you want to be 70, 30, 60, 40 at that stock and bond level, if you will. But we're fans of alternatives, right? And an alternative, if you will, is something that is not correlated to stocks or not necessarily correlated to bonds. And at least at Buckingham, we've got a handful of options. And because we're fiduciaries, we operate with your best interests at heart. We don't say that you need to have these or not. And at least within our practice, I would say probably half our clients incorporate some or all of these types of alternatives. And that could be a lending portfolio, it could be real estate, it could be reinsurance, it could be a variety of things. So I'll start with that. And that's how we're trying to beat this problem of yield. We operate on a total return basis. So when people come to us and say, I like to buy dividend paying stocks, we're not fans of that because, as you know, a dividend is just returning your money to you, right? So we skew, if you will, towards that overall asset allocation, incorporating non-correlated alternatives. And I'll let Larry talk about that because he's written close to 20 books and has covered this ad nauseum. And I'm going to let the expert speak.
Yeah. So let me address it this way. In our typical stock and bond portfolios, as Adam said, we want the bond portion of the portfolio to act like the anchor that keeps the ship safe in port in the midst of a storm. And that means you don't want it to be going down when your equities are being slammed by the markets, whatever the cause may be, a 9/11 event, a COVID crisis, a great financial crisis, an oil embargo, a war. And if you look at what most people think of alternatives like high yield bonds or real estate, when you get a 2001, a 2008, a COVID crisis, those go down sometimes as much or more than equities do. So just when you need that safety, they get hit just as hard, and that can cause you to exceed your tolerance for risk, panic and sell, as one gentleman told us he did last year. So that's a real problem. Second problem that comes out of that is you can't rebalance a portfolio if both parts are down. On the other hand, because we only buy with the bond portion of the portfolio, only the safest bonds, either AA or AAA rated municipals, CDs, or government bonds issued by the government, by the Treasury, they tend to go up during bear markets because you get flights to quality. So when COVID was hitting and the markets dropped 35%, bonds may have gone up 10%. In 2008, when stocks dropped 60%, bonds had their best years ever. So Adam was able to take the part of the bond portfolio, instead of the portfolio dropping 50%, and by the way, junk bonds dropped 50, 60, 70%, real estate dropped, somewhere in the 30, 40, 50%, depending upon the type. Instead, Adam was able to sell assets which had gone up, which first of all reduced the overall loss, and then was able to sell high and buy low, buy more stocks when prices were lower, and they benefited greatly when the markets recovered. So that's really important. However, having said that, we find there are clients who can take more risk but choose not to, but want to see if they can goose their returns a little bit without taking equity-like risk. And today, what you're seeing is a dual problem. Not only do you have much lower interest rates on the safe bonds, but here's something that I would bet almost nobody on this call is likely to know. Say a 10-year bond you buy today is actually issued by the government is much riskier than a 10-year bond you would have bought 15 years ago, even though it's the same 10-year maturity. When yields are lower, what's called the duration of that bond gets much higher. So a 1% move in interest rates will cause a bond with a 2% yield to move in price much more than it would if the same bond had a 5 or 6% yield. So what's called duration or effective maturity has become much longer. A 10-year bond might have had a duration of, say, I'm just making this up, 8 years 10 years ago, and now its duration is gone up, to a higher number, 9 or 10. So the numbers are there. So bonds are much riskier than they were, and yet you're getting much lower yields. We think there's a good solution for people who can take some more risk, and that's to take some portion of their bond portfolio and move it to alternative assets which have much higher yields, partly because they're illiquid, partly because they take other kinds of risks. Now, if the risks are different, then that's a form of diversification. So their risks may not show up at the same time as the risk of stocks. So Adam mentioned reinsurance risk. So insuring against, for example, hurricanes and earthquakes. Bear markets don't cause hurricanes and earthquakes, so they're not correlated. And most of the time, when stocks go down, reinsurance tends to go up because most years it goes up. But you will have bad years whenever we have lots of hurricanes or earthquakes. Just so everyone wants to know, Warren Buffett is one of the largest investors. He owns one of the largest reinsurance companies. And the fund we use partners with 10 of the largest reinsurance firms. We think that product today has an expected return in the low double digits, and it has an expected volatility of about half of the stock market. So we think that's worth considering, but it is risky, but it's different risk. We also invest in what Adam referred to as alternative lending. Here, there are two funds we use. One that makes loans to middle market companies that aren't big enough to go to the public markets. The banks have abandoned that space since 2008 because they had to raise capital due to the changes required of them by Dodd-Frank and regulations from the Treasury. And today, a fund we use called Cliffwater Middle Market Lending Fund, it's cranking out regularly 65, 70 basis points a month, has very little risk in terms of the longer term, 20-year evidence of less than 2% defaults and about 70% recovery rates. So if you have 2% defaults and you recover 70%, you lose 60 basis points a year. Even in an 08, we believe the fund would have lost only maybe mid-single digits. So much less than equities, but it won't go up like a safe bond would. So in the COVID crisis, when treasuries were going up 5 to 10%, depending on maturity, this fund lost about 3%. Now, that's a lot better than the 35% or more stocks were dropping. And yet the expected return today is 7 to 8%, which is higher than the expected return to, say, the S&P 500. We also invest in one other fund, which makes loans to consumers and small businesses. That's been cranking out returns in the roughly 10% range. And we think that has limited downside risk, about maybe 8% or so in a really severe economic cycle. But again, both the Cliffwater and the Alternative Lending Fund, they make loans based on very short-term interest rates. They have no inflation risk. So you're picking up a big premium over safe bonds, and you're getting rid of the inflation risk that a typical bond portfolio will have. In return, you're taking on some different risks that may not correlate well with stocks. But they are risks. They're not free lunches, but the premiums are large. I think personally, they right now are the safest investments relative to the expected return that you can find, because they're equity-like with much less risk. And if you combine a few of these in a portfolio, the risks are even less because they're not correlated either. So we think their correlation of a portfolio of these is only about 1/4 the volatility of a global equity portfolio. But they're not liquid. They're only able, they're run through what are called interval funds, which gives you the ability to withdraw a minimum of 5% every quarter, but you could be restricted to that if everyone wants out at the same time.